In the next 17 days, one boring regulatory filing could answer a question that is lighting up financial circles right now. Did Warren Buffett make one final, gigantic move into silver? Not a cute position, not a headline-sized nibble. The rumor says $50 billion, physical silver. And if that sounds insane, good, it should. Because today is January 31st, 2026, and we are sitting in the gap between a story people want to believe and the paperwork that would prove it. So in this video, we do three things. First, we separate rumor from reality with a simple timeline anyone can verify. Second, we run the math on what a $50 billion silver move would actually mean in ounces, vault space, and global supply. Third, we explain why this story changes everything in 2026, even if the rumor turns out to be wrong, because the real story is not a celebrity investor. The real story is a market so small, so essential, and so physically constrained that a single mega buyer, real or imagined, can bend the entire narrative. And before we start, this is education, not financial advice. We are talking about market structure, filings, and industrial demand. Make your own decisions. All right, let's get into it. Warren Buffett's final act as CEO was to park $50 billion in physical silver. It spreads because it rhymes with history. In the late 1990s, Berkshire Hathaway bought roughly 129.7 million ounces of silver. That was real. It was disclosed. It happened. But the 2026 claim is different. As of this moment, there is no confirmed filing showing a $50 billion silver position. No official document, no verified disclosure. So how would we know? Not from someone on social media, not from a screenshot of a price chart, not from a confident voice in a suit. We would know from a Form 13F. A Form 13F is the quarterly report that large investment managers file to disclose many of their equity holdings. And while it will not show every possible way someone could gain exposure, it is still the first place the market looks for a big move story. Here is the timeline. Berkshire's leadership transition became official on January 1, 2026, with Greg Abel taking over as CEO while Buffett remains chairman. The next major public window into Berkshire's portfolio moves is the fourth quarter 2025 13F filing. That filing is due 45 days after quarter end, but because the usual deadline lands on a weekend and a market holiday, the due date rolls to the next business day. That date is Tuesday, February 17, 2026. So when people say, as of the last hour, here's the updated status, the honest answer is, the status is unknown until February 17. Until that day, the $50 billion claim is a prediction, not a fact. Now, a quick note. Even if Berkshire did something in silver, it might not appear on the 13F. Physical bullion is not a listed stock. Some commodity exposures do not show up in that report. There are workarounds, mining equities, royalty companies, funds, structured notes, private contracts, and more. But the rumor specifically says physical silver. That is not a ticker symbol. That is bars, logistics, and custody, which means the market will be looking for indirect clues and related disclosures, not just one line item. So don't worship the rumor. Measure it. Rumors are wind. Paper is ink. Physical is weight. Weight leaves marks you can track. And the fastest way to measure it is to ask, could $50 billion in physical silver even be done? Let's run the numbers. $50 billion is a number that breaks intuition, so we turn it into ounces. At $80 per ounce, $50,000 buys. 50,000, 80, or 625,000 ounces. 625 million ounces. If silver were $100 per ounce, it would still be 500 million ounces. Now translate ounces into the real-world unit of institutional silver, the 1,000 ounce bar. 625 million ounces is about 625,000 of those bars. Imagine a wall of metal measured not in jewelry boxes, but in pallets. Now translate that into supply. Global mined silver supply in a year is on the order of the high hundreds of millions of ounces. Total supply includes recycling, but even then, the market is not built to casually absorb a single buyer trying to take down 500 million ounces quickly. This is why the rumor is so explosive, because a $50 billion physical move is not just bullish, it's a structural event. It's the difference between buying a stock and buying a freeway. And now ask the next question, where would it go? Physical silver is heavy. One 1,000 ounce bar is about 68.6 pounds. 625,000 bars times 68.6 pounds is roughly 42.9 million pounds. That's about 19,500 metric tons of silver. That is a logistics operation, not a trade. It means vaulting, insurance, chain of custody, audits, delivery schedules, and the kind of buying that does not happen on a public screen with a retail buy button. So if a move like that is real, it would likely be staged, distributed, and blended into the supply chain over time. And here's the critical point. If you are trying to buy that much physical silver, the price on your screen becomes less relevant than the answer to one question. Can you actually get it? That's the line that separates paper from physical. And in 2026, that line is where the story lives. For decades, silver lived two lives. Life 1, it was a monetary metal, a hedge, a cousin of gold. Life 2, it was an industrial material, conductive, antibacterial, reflective, useful. In 2026, those two lives collide, and a third identity appears. Silver as a strategic technology metal, because the modern economy is building things that behave like silver-eating machines, solar panels, electric vehicles, power electronics, advanced batteries, data centers, high-density connectivity, sensors, specialized contacts, high-reliability switches. You can argue about the exact numbers, but the direction is not controversial. Industrial demand is large, and it is rising. And here is what makes silver uniquely dangerous to underestimate. You don't replace it easily. You can thrift it, reduce it, redesign around it, and sometimes substitute it. But you do not flip a switch and replace silver everywhere without trade-offs in conductivity, reliability, and performance. That is why the people who believe this rumor think it fits Buffett's logic. Buffett has famously mocked assets that just sit there and do nothing. Silver, in 2026, does something. It moves electrons, it enables infrastructure. It is literally consumed in industrial processes, dispersed in tiny amounts that are difficult to recycle back into bullion. That changes the narrative from shiny rock to productive input. And if you're an investor who loves productive assets, you can see how the story writes itself. But the story is still not proof. So we go back to the market and we ask, what is the market doing right now? Over the last 48 hours, silver has shown the kind of price action that turns rational people into poets. A violent drop. A fast unwind, a move big enough that different feeds and different regions display different levels and different narratives. And what matters here is not the drama of the candle, it's the mechanism. When a market is crowded, leveraged, and thin, it can move like a trapdoor. A catalyst hits, rate expectations reprice, the dollar firms, volatility spikes, then the plumbing takes over, margin calls trigger, stops get swept, liquidity providers step back, spreads widen, the next bid is lower than you think it should be. This is the moment where paper markets can print a price that looks like cheap silver, while the physical market behaves like no silver available. And that is why you hear the same sentence from serious physical buyers over and over. You can't buy size at that price. Now, does the last drop prove a shortage? Not by itself, but it does expose how quickly confidence can evaporate in a market that is small relative to global capital. Silver is not a trillion-dollar ocean. It is closer to a deep lake, and when a lake gets hit by a storm, the whole surface changes at once. If Berkshire, or any mega buyer with a 50 buy-lot budget, were quietly accumulating physical silver, what signals might appear? Not a neon sign, not a confession. Signals in the real world tend to be boring and indirect. Here is what you would watch. 1. Persistent premiums. If local coins and small bars carry unusually high premiums over the quoted spot price, and those premiums persist even when the screen price falls, that indicates the physical channel is tighter than the paper channel. 2. Delays in allocation language. When wholesalers shift from in-stock to allocation, delayed shipment, or limited availability, that is not a chart, that is the supply chain speaking. 3. Tightness in large bars. Retail can run out of small products for many reasons. But when the institutional bar market tightens, when delivery windows stretch, when the big unit products get rationed, that points to something larger. 4. Spread behavior. Watch the gap between different pricing venues and the cost to move metal across regions. If the gap persists, it suggests friction, transport, approval, vaulting, or simply scarcity. Now let's go back to the part of the story that is absolutely real. In 1997 and 1998, Berkshire bought 129.7 million ounces of silver. Back then, the thesis was simple math. If industrial and jewelry demand consistently exceeds mine production plus recycling, the difference has to come from above-ground inventories. And inventories are finite, so either demand falls, supply rises, or price rises until the imbalance resolves. Buffett described that logic publicly. No magic, no secret algorithm, just a gap filled by inventory until the inventory isn't there. That's why the 1997 trade became legendary. Not because it was flashy, because it was boring and correct. And that is why it echoes in 2026. If the world is once again consuming more silver than it produces for multiple years in a row, then the same inventory math returns. And when that math returns, it attracts two very different kinds of buyers. The paper buyer, who wants exposure, leverage, and liquidity. The physical buyer, who wants deliverability. Those two buyers can coexist in calm periods. In stress periods, they diverge violently. Now here's the twist. This video is not actually about whether the rumor is true. It's about why the rumor is believable, because a rumor like this can only thrive in a market with three properties. 1. The market is small relative to capital. 2. The metal is essential to modern industry. 3. The boundary between paper price and physical availability is widening. In a huge market, a $50 billion rumor would be shrugged off. In a market where the physical channel is tight, a $50 billion rumor feels like a match near dry grass. And that is the bigger story of 2026. Silver has become a market where trust and deliverability matter as much as price. And when that happens, two things follow. First, volatility becomes the weapon, not because someone has to conspire, but because thin markets amplify forced flows. Second, narratives become catalysts, because in a market this tight, stories change behavior, and behavior changes inventory. So whether Buffett bought or not, the fact that people can imagine it tells you something about the moment we are in. If you want to understand the logic of a final bet story, ignore the romance and focus on the constraint. A mega buyer does not bet on a green candle, they bet on a bottleneck. They bet on the idea that a critical input is becoming harder to secure at scale. And in technology supply chains, the most important sentence is not, "What's the price?" It's, "Can we get guaranteed delivery?" Because if you run a factory, an energy build-out, or a hardware pipeline, you cannot ship a press release. You need metal. That is why silver is different from a typical macro hedge. It sits inside the physical world. And when an asset sits inside the physical world, the rules change. So here's the practical takeaway for a skeptical audience. Treat February 17th, 2026 like a checkpoint, not a prophecy. On that day, filings and disclosures will add clarity about what was and wasn't done in late 2025. You may not get a perfect answer. You may get partial clues, but the fog will thin. And until then, you can protect yourself from being manipulated by one simple habit. Whenever you hear a giant claim, ask, what would have to be true for this to be true? For the $50 billion physical claim to be true, at least some of these would likely be true. The buying would have been gradual, not one day. The buying would have routed through multiple channels and custodians. The market would show stress in deliverable forms. And the story would eventually collide with disclosures, audits, or supply chain realities. If none of that appears, then the rumor will fade. But if even a fraction appears, then the market has to reckon with a deeper point. The physical silver market is not built for a world of mega buyers. So let me end with the real question. Not, did Buffett buy? The real question is, in 2026, do you understand the difference between a price and a supply? Because price is what you see, supply is what you can actually get. And the entire silver story of 2026, the surges, the crashes, the regional gaps, the rumors, the obsession with filings, is the market slowly admitting that those two things can drift apart. If February 17th comes and the rumor is dead, we still learned something valuable. Silver is now important enough that people believe legends can return to it. And if February 17th comes and the rumor lives, then we are not watching a trade. We are watching a structural shift in the most underestimated strategic metal on Earth. Either way, the era of silver as a sleepy side bet is over. If you want me to follow up the moment the filings drop, subscribe and comment one word, delivery or chart. Because in 2026, that's the whole game.